From 2013 to 2021, Grayscale Bitcoin Trust was the only regulated way for U.S. institutional investors to hold Bitcoin in a traditional brokerage account. At its peak, GBTC managed over $40 billion in Bitcoin and traded at premiums of 20 to 40% above the value of the underlying Bitcoin it held. Institutional arbitrageurs, hedge funds, family offices, created new GBTC shares at NAV by depositing Bitcoin, expecting to sell them on the secondary market at the premium 6 months later. When that premium collapsed to a discount in early 2021, those arbitrage trades lost hundreds of millions of dollars and created sustained selling pressure on GBTC for years. When GBTC finally converted to a spot ETF in January 2024, it lost $18 billion in outflows in its first 6 months. Investors who had been trapped by the discount structure finally had a path to exit. This is one of the most instructive case studies in structured product mechanics, arbitrage traps, and institutional product design failures in crypto's history. Grayscale Bitcoin Trust is a Delaware statutory trust that holds Bitcoin and issues shares representing fractional ownership of that Bitcoin. Unlike an ETF, the original GBTC structure had no redemption mechanism. Investors could not exchange shares back for Bitcoin. This one-way creation structure meant that once Bitcoin was deposited into GBTC, it was permanently locked until SEC approval for an ETF conversion. New shares could only be created by accredited investors depositing Bitcoin. They could be sold on the secondary OTC market after a 6-month lockup. The premium or discount to NAV reflected supply and demand imbalances in the secondary market. High institutional demand with limited supply created the 20 to 40% premium. When institutional demand reversed and supply from arbitrageurs overwhelmed buyers, the premium collapsed to a discount that reached 49% below NAV at its trough in late 2022. The premium and discount mechanics are the defining structural characteristic of GBTC and the source of both its massive wealth creation and its institutional capital trap. The GBTC premium and discount history quantifies the full cycle of the product's institutional impact. The premium peaked at approximately 40% in December 2020, when Bitcoin was rallying toward $30,000 and institutional demand for a regulated Bitcoin vehicle vastly exceeded available supply. At that peak, GBTC's market value exceeded the value of its Bitcoin holdings by approximately $8 billion. The premium began collapsing in early 2021 as new alternatives emerged, and arbitrageurs who created shares at 6-month lockup began flooding the secondary market. By December 2021, GBTC had moved to a discount. The discount reached 49% below NAV in December 2022, after FTX's collapse amplified crypto market distress. Throughout 2022 and 2023, GBTC's discount was a major drag on Genesis Capital's balance sheet, contributing to its eventual bankruptcy. When GBTC converted to an ETF in January 2024 and the discount closed to near zero, $18 billion in outflows followed as trapped investors exited. For institutions evaluating GBTC versus alternative Bitcoin vehicles today, the comparison has fundamentally shifted since the ETF conversion. GBTC as a spot ETF now competes directly with BlackRock IBIT and Fidelity FBTC, but with a major structural disadvantage. Grayscale charges a 1.5% management fee versus 0.25% for IBIT and 0.25% for FBTC. This fee differential of 1.0 to 1.25% annually compounds dramatically over multi-year holding periods. At the current fee differential, GBTC will underperform IBIT by over 10% over 10 years from fees alone, before any performance difference. The only institutional use case where GBTC retains an advantage is for investors already holding it in taxable accounts. Exiting to buy IBIT would trigger a capital gains realization, and the after-tax cost of switching must be weighed against the ongoing fee drag. GBTC's historical structure created institutional risks that the ETF conversion has partially resolved and partially shifted. The discount trap risk, being locked in a vehicle trading at a massive discount to NAV with no exit, is resolved by the ETF redemption mechanism. But fee drag risk is now the primary concern. At 1.5% annually on $20 billion in assets, GBTC collects $300 million in fees per year, fees that directly erode Bitcoin price exposure for long-term holders. Concentration risk in Coinbase Prime custody applies to GBTC as it does to IBIT. The remaining institutional concern is tax inefficiency risk for existing holders. The decision to hold GBTC versus switch to IBIT must account for unrealized capital gains in existing GBTC positions, creating a complex optimization problem that requires tax counsel input. Genesis Capital's exposure to the GBTC discount provides the most costly institutional case study of the premium at discount arbitrage trap. Genesis Capital, then one of the largest crypto lending firms, had accumulated a massive GBTC position as part of its institutional lending book. Clients borrowed USDC from Genesis, deposited Bitcoin into GBTC, sold the resulting shares at a premium after lockup, and returned the proceeds. When the premium collapsed to a discount, the shares were worth far less than the Bitcoin deposited. Genesis estimated losses of over $1.1 billion from GBTC discount exposure. Combined with losses from the Three Arrows Capital collapse, these GBTC losses contributed directly to Genesis Capital's January 2023 bankruptcy, which in turn triggered losses for Gemini-owned customers. The GBTC discount trap cascaded through multiple institutional counterparties, demonstrating how structured product mechanics can create systemic risk across the crypto lending ecosystem. Institutions with existing GBTC holdings need a structured decision framework to optimize their position. Step 1 is cost basis and tax analysis. Calculate the unrealized gain or loss in existing GBTC positions and estimate the capital gains tax liability of switching to lower fee alternatives. Step 2 is break-even calculation. Determine how many years of fee savings from IBIT would be required to offset the tax cost of switching. At 1.25% annual fee differential, the break-even for a 20% long-term capital gains rate is approximately 8 years. Step 3 is mandate review. Confirm that the institution's IPS permits switching from a trust vehicle to an ETF and that neither product requires explicit approval from an investment committee. Step 4 is execution timing. Assess whether the switch can be executed in a low volatility period to minimize market timing risk during the exchange. 3 GBTC-related mistakes define poor institutional product management. First, executing the GBTC premium arbitrage without stress testing what happens if the premium collapses. Genesis Capital's exposure to the discount trap was the result of assuming the premium would persist indefinitely. Second, switching from GBTC to IBIT without completing the tax analysis first. For investors with large unrealized gains, the immediate capital gains cost can exceed a decade of fee savings. Third, continuing to hold GBTC for new allocations after lower fee alternatives became available. New Bitcoin ETF allocations post-January 2024 should use IBIT or FBTC by default. There is no rational case for paying 1.5% when 0.25% alternatives are available. GBTC's history is a masterclass in structured product mechanics, arbitrage dynamics, and the institutional consequences of illiquid no-redemption structures. The product simultaneously made Grayscale one of the wealthiest companies in crypto and trapped institutional capital at a 49% discount. The post-ETF conversion lesson is straightforward. For new Bitcoin ETF allocations, fee minimization is the primary selection criterion. For existing GBTC holders, tax-adjusted break-even analysis determines the optimal switch timing. GBTC's story is one of the most instructive product design case studies in institutional crypto. Understanding the mechanics prevents repeating the mistakes. Subscribe to Crypto Mechanics for institutional-grade crypto analysis delivered weekly.